I'm Hale Stewart, and I'm with Hale Stewart Law, which is where finance, economics, and law meet. And this video on alternative risk transfer and captive insurance is part of my Insurance University series. And the idea behind these videos is to help insureds and potential insureds understand certain policies and concepts that are fairly common in the insurance industry. Now, today, as I mentioned, I'll be talking about captives and alternative risk transfer. But before I get there, two quick points. Number one, I am not your lawyer, which means that this video does not establish an attorney-client relationship. So please don't think it does. And number two, I have some notes right down here. They're on the keyboard of my laptop from which I'm filming this video. And I'm going to look at them to make sure I catch certain points. So I apologize for looking down. Now, captives are part of what I call alternative risk transfer, or ART. So if there's this thing called alternative risk transfer, what is non-alternative or traditional risk transfer? And that involves two things. You buy third-party insurance from somewhere, and you take on a self-insured retention. Either that means either you have a deductible with a third-party policy, or you self-insure the entire risk. Now, this actually has some tremendous benefits for you, the insured. Number one, you're exchanging a predictable cash flow for an unpredictable cash flow. Now, hypothetical numbers here. Suppose you own property along the coast. Property is valued at $1 million, and you can buy insurance that covers every single conceivable risk for $100,000. Now, think about this. You know that you can spend $100,000 to get all your insurance needs covered, and in the event of total catastrophe, your property is going to be rebuilt, or you're going to be completely reimbursed. Or you could say, well, I'm not going to buy insurance, but I might have to spend $0 because there's no claims, or I might spend $500,000 or $1 million. The point here is that you don't know. And that uncertainty makes financial projections and financial management difficult. So the predictable cash flow is a wonderful benefit here. Most of these policies are pretty efficiently priced. There's an area of the insurance market that I call core insurance policies. And these are basic, I think of them as plain Jane. Almost everybody's got these coverages. Commercial property, commercial general liability, auto, excess umbrella, okay? Those policies, there's a lot of competition for them. You're going to find good pricing for them. And they're well-known policy provisions. The commercial general liability policy that we know first came into existence in 1954. There are certain ideas and concepts in property insurance that go back 100 years. The point here is that an insurance lawyer can say, well, here's your CGL and here's what that covers. And oh, by the way, there's a boatload of case law that I can reference to get a better idea of if a particular risk is covered or not covered. Now, there are some drawbacks to this. One of them is what we call the morale hazard. Fancy term. All it really means is that you're less inclined to do something about the risk. Think about it this way. Suppose you have a tremendous amount of insurance coverage. As a result, you're going to be less inclined to try and mitigate risk yourself. And the reason why is that you've got insurance. Why should I worry about this or try to mitigate the risk? Because I'm covered. We have also what I call the boilerplate problem. Now, earlier on, I talked about how the policy provisions are commonplace, okay? Insurance in the U.S. is done on forms. And the forms are written by an organization called the ISO, Insurance Services Office, etc. The problem here is that in order for ISO to get these insurance provisions approved in a number of states, they have to draft these policy provisions broadly. Ask any lawyer. Broad drafting means you're inviting a conflict. So that's one of the drawbacks. Now, in addition, the more unpredictable the loss, the less likely someone's going to underwrite it and the more costly it will be. As I mentioned, this works best with what I call core policies. Again, policies that are very common. Commercial liability, commercial property, commercial auto, excess and umbrella, okay? Once you move into what I call satellite policies, single risk policies, employment practices liability, E&O, pollution, builder's risk, sometimes these risks can become costlier and you're more likely to find a benefit in underwriting these risks yourselves. All that being said, let's now talk about an alternative risk transfer program, because previously I talked about traditional. And there's typically three parts to this. Four parts. Third-party insurance, a self-insured retention, potentially a captive insurance program, and a risk management program. Now, I've already talked about third-party insurance, the pros and the cons. I guarantee, I've yet to see a captive program that does not utilize third-party insurance, and primarily for the benefits involved, okay? Well-known policy provisions, very efficient pricing, etc. But with a captive insurance program, we're going to include a self-insured retention. One of the first things we do in a captive program is to underwrite a large deductible. So, for example, we have a commercial liability policy, but instead of having a standard $5,000 deductible, the insured takes a $100,000 deductible. This means the insured is responsible for the first layer of risk. Now, even though he's formed his own insurance company, the risk is coming out of his pocket in a kind of a second-handed way. As a result, the insured is now inclined, or more inclined, to reduce the cost of risk, and that reduces the morale hazard. There's a big key component of all that. In addition, the insured has to have a risk management program from the top of his company down to the very bottom. The C-suite has to buy in. They have to write it, draft it, and populate it throughout their organization. They have to get behind it, tell the employees they're involved with it, and even the lowliest employee has to somehow be involved with this. And the reason why is this creates a culture where your job is to lower the cost of your risk. Now, finally, there's the formation of a captive insurance company. All this is an insurance company that you own. So that means that you get to fulfill your lifetime obligation of finally going in the insurance business, right? Silly joke. This is an insurance company that underwrites risks of the parent company. So let's suppose you have Acme Corporation. Acme Corporation now has Acme Captive. And Acme Captive sells insurance to Acme Corporation and nobody else. That right there is a very high-level explanation of alternative risk transfer and captives and how they work. There's actually a lot more nuts and bolts to this whole thing. If you have additional questions, please give me a call, 832-330-4101. Call me, text me, or email me. You can email me at halestewart@halestewartlaw.com. I hope you have found this video very helpful and informative. Thank you for watching.